Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hong Kong Exchanges and Clearing Limited annual report. Hong Kong Exchanges and Clearing Limited provides a wide range of businesses and services through its various segments. In the cash segment, it offers equity products traded on the Stock Exchange of Hong Kong Limited, as well as listing, depository, and nominee services. The equity and financial derivatives segment provides trading and clearing platforms for equity and financial derivative products, such as stock futures and options. The company also operates a commodities exchange in the United Kingdom, offering base, ferrous, and precious metals futures and options contracts. Additionally, it operates Qianhai Mercantile Exchange Co., Limited, a commodity trading platform in mainland China. The data and connectivity segment offers services that provide access to its platforms and infrastructure, including network, terminal user, data line, and software sublicense services. In terms of specific businesses and services, Hong Kong Exchanges and Clearing Limited provides equity products traded on the Stock Exchange of Hong Kong Limited, listing, depository, and nominee services, trading and clearing platforms for equity and financial derivative products. Commodities exchange in the United Kingdom, Qianhai Mercantile Exchange Co., Limited. Commodity trading platform in mainland China. Network, terminal user, data line, and software sublicense services. Market data relating to the Hong Kong cash and derivatives markets overall. Hong Kong Exchanges and Clearing Limited plays a crucial role in facilitating financial transactions and providing access to various markets and products for issuers and investors. Hong Kong Exchanges and Clearing Limited maintains a market capitalization of $513 billion, broadly in line with the industry peer group. Hong Kong Exchanges and Clearing Limited trades at a similar price-to-earnings ratio of 29 times and a similar price-to-book ratio of 8.83 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. As this company belongs to the financial data and stock exchanges industry, the liability ratio is less meaningful for valuation. Investors should instead focus on return on assets, ROA, and return on equity, ROE, to better assess the company intrinsic value. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 3.21%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified from the extracted summaries. On the growth side, the core business revenue has seen a significant increase of 32% due to higher trading and clearing fees driven by record volumes across various markets. Net investment income from corporate funds has also risen by 7%, mainly due to non-recurring gains on valuation of unlisted equity investments. In addition, trading fees have surged by 80%, while clearing and settlement fees have increased by 58%. Depository, custody, and nominee services fees have grown by 33%, and other revenue and sundry income has risen by 9%. The equity and financial data segment has seen a remarkable growth of 109%, followed by the commodities segment, with an increase of 193%. On the decline side, revenue has decreased in 2020 and 2018 due to various factors. Investment income has declined by 45% in 2025 compared to 2024. The decrease in investments valued at fair value and reduction in debt securities have also contributed to the revenue decline. Other notable drivers include an increase in deferred revenue arising from unsatisfied performance obligations, which is expected to be recognized as revenue in 2026, indicating a potential increase in revenue in the next year. Overall, these factors highlight the key drivers of revenue growth or decline for the company. The net income of the company experienced a significant increase between 2016 and 2024, rising by 209% from $5,741 million to $22,796 million. However, there was no change in net income from 2024 to an unspecified year, with the figure remaining at $4,000 million. The profit margins of the company also underwent a notable improvement during this period. The pre-tax profit margin increased from 61% in 2016 to 67% in 2024, indicating that the company was able to maintain a higher level of profitability. Additionally, the cost-to-income ratio decreased from 31% in 2016 to 26% in 2024, suggesting that the company became more efficient in managing its costs and generating revenue. The company's financial performance indicates a strong ability to generate cash from its core operations. A key indicator of this is the operating cash flow, which measures the amount of money generated by a company's business activities. According to various sections of the report, the company has consistently demonstrated positive operating cash flow. On page 70, it is stated that the company's operating cash flow is $2,053 million, calculated from net operating expenses and EBITDA, earnings before interest, taxes, depreciation, and amortization. This figure suggests a significant amount of cash being generated from the company's core operations. Furthermore, on page 177, it is noted that there has been an increase in operating cash flow from $54,497 in 2024 to $68,691 in 2025. This indicates a growing ability of the company to generate cash from its business activities. Additionally, on page 217, it is explicitly stated that the company's operating cash flow status is positive. Finally, on page 232, it is confirmed that the company is indeed generating positive operating cash flow. These multiple confirmations demonstrate a consistent and strong financial performance by the company in terms of operating cash flow. The company's debt level has undergone significant fluctuations over the past year. Initially, gross debt decreased by $398 million, page 81, indicating a reduction in liabilities. However, subsequent reports reveal an increase in total debt from $327,222 in 2024 to $522,046 in 2025, page 145. Furthermore, total debt securities also rose from $50,704 million at the end of 2024 to $65,803 million by the end of 2025, page 172. Nevertheless, another report shows a decrease in gross debt by $54 million, representing a 12% reduction, page 206. The most consistent information suggests that gross debt decreased from $452 million in 2024 to $398 million in 2025, page 210. Regarding interest expenses, the data is somewhat inconsistent. Some reports indicate a significant decrease in interest expenses from $96 million in the previous year to $96 million in 2025, page 153, while others show a reduction from $114 million in 2024 to $96 million in 2025, page 160. However, one report contradicts these findings by stating that interest expenses increased by $15 million at the end of 2025 compared to the previous year, page 215. The company's performance was mixed across various segments and regions. On the positive side, corporate and commodities segments stood out with strong revenue and EBITDA growth. The equities market, multi-asset ecosystem, fixed space, derivatives market, ETP markets, and cash market also performed well or achieved record highs. In terms of specific regions, Hong Kong and the United Kingdom demonstrated strong revenue and non-current assets growth. These regions were among the top performers in the company's global operations. However, not all segments fared equally well. The connectivity segment struggled with poor EBITDA performance. This was a notable exception to the otherwise robust results across other areas of the business. Management's outlook for the company remains cautiously optimistic despite ongoing macro landscape uncertainty. They see opportunities for growth as global investors seek diversification and risk management in Asian assets. The company is committed to staying competitive globally through its strategic development program. A key driver of growth will be increasing trading and clearing fees, driven by record volumes across various markets. Management is also focused on developing a multi-asset ecosystem, with a focus on Hong Kong's FIC market. This expansion into adjacent businesses such as indices and fund services aims to drive capital flows and liquidity. The company remains committed to its 2040 net zero targets, making significant progress in decarbonizing operations through sustainable aviation fuel and low-carbon fuels. Management is also prioritizing ESG stewardship and transparency, leading sustainable finance practices, and creating positive community impact. Overall, management's strategy emphasizes growth, sustainability, and responsible business practices, positioning the company for long-term success despite short-term volatility. Acquisitions and divestitures are significant business strategies that involve the buying or selling of assets, businesses, or investments. In this context, acquisitions refer to the purchase of new assets or companies by an organization. The Hong Kong Exchange, HKEX, has made several notable acquisitions in recent years. One of the most significant was the acquisition of a 20% stake in CMU OmniClear on page 6. This move demonstrates HKEX's commitment to expanding its reach and influence in the global financial markets. Additionally, HKEX acquired office premises in Riyadh and established a Memorandum of Understanding (MOU) with the Abu Dhabi Securities Exchange. HKEX has also made significant investments in its infrastructure and technology. For example, it developed and upgraded various trading and clearing systems on page 79. Furthermore, HKEX designated Hong Kong as an LME warehouse delivery point and Jeddah in Saudi Arabia as an operational LME warehouse delivery point. These moves are aimed at enhancing the efficiency and competitiveness of the exchange. In terms of divestitures, HKEX has also made notable transactions. On page 71, it redeemed its external portfolio for $5.8 billion. This move is likely aimed at optimizing its asset allocation and reducing risk. Similarly, on page 214, HKEX redeemed its external portfolio to fund the acquisition of its permanent headquarters premises in 2025. Overall, acquisitions and divestitures are crucial strategies that enable organizations like HKEX to adapt to changing market conditions, expand their reach, and optimize their assets. By carefully selecting which assets to acquire or divest, companies can create value for their shareholders and stakeholders. The company has demonstrated its commitment to returning value to shareholders through various means. Firstly, it is evident that the company has paid dividends to its shareholders. This is supported by multiple references throughout the document, including the increase in total dividend per share from $9.26 to $12.52, and the declaration or payment of dividends on several occasions. Furthermore, the company has also engaged in share buybacks, which is another way for companies to return value to their shareholders. The specific details of these transactions are outlined in the document, including the purchase of 1,256,704 shares at a total consideration of $512 million through the Trustee of the Share Award Scheme. This indicates that the company has actively sought to reduce its share count and potentially increase earnings per share for existing shareholders. That concludes the financial summary for Hong Kong Exchanges and Clearing Limited. Feel free to comment below, and I will be happy to answer them when possible.